Applied Digital is trading live at $31.97, and it is getting hammered, down a steep 3.38% on the day. And that single violent move you're watching on your Fidelity mobile app or Robinhood app is not just a random dip. It is the entire high-stakes billion-dollar argument over this company's future happening in real time. The expectation, the story that has sent this stock on a tear this year, is that this is the next great picks and shovels play for the artificial intelligence build-out. It's supposed to be a mini NVIDIA stock, a company providing the essential high-tech real estate, the data centers that the AI boom is built on. The expectation is that you are looking at the ground floor of an AI infrastructure giant. But the reality, the reason it's bleeding 3.38% today, is that this company is not a magical AI play. It's a hyper-leveraged, capital-intensive, high-debt construction business that is burning cash at a terrifying rate. The tension between the AI dream and the balance sheet nightmare is at a breaking point, and today, the nightmare is winning. Let's establish the common ground, because the bull narrative is powerful, and it's what got us here. The story is that Applied Digital, APLD, saw the future. They masterfully pivoted away from the volatile crypto mining world and repositioned themselves as a premier developer of next-generation high-performance computing HPC data centers. This is exactly what AI companies need. They don't just build any data centers, they build the specialized, liquid-cooled facilities that can handle the immense power and heat from thousands of NVIDIA stock GPUs. The story got its crown jewel, its ultimate validation, in the form of massive, multi-billion-dollar contracts. We are talking about an $11 billion 15-year lease agreement with CoreWeave, one of the biggest private AI cloud providers. This isn't a maybe, it's a signed, sealed, and delivered contract. This is what caused the stock to rocket up over 300% this year. This is why every analyst on Wall Street, from Needham to Craig Hallam to H.C. Wainwright, has a buy rating on it, with price targets pointing way, way higher. The expectation is set. They have the tech, they have the contracts, they are the future. And now for the reality that is pulling this stock down to $31.97. The reality is the balance sheet. This is the part that most traders using the SoFi Active Investing platform or those just starting with online investing tend to ignore. Let's talk about the numbers from their last filing. As of August 31, 2025, Applied Digital had roughly $114 million in cash. That sounds okay until you see the other side of the ledger, $687 million in debt. This is a company that is drowning in leverage. And how is their cash flow? Well, for the fiscal year 2025, their free cash flow was negative $772 million. They are not generating cash. They are incinerating it. Their quick ratio, a key measure of whether a company can pay its immediate bills, is a terrifying 0.40. Anything under 1.0 is considered dangerous. This is not the financial profile of a healthy, stable investment. This is the financial profile of a high-risk construction company in the middle of a bet-the-farm build-out. They are a company with a beta of 6.77. That is not a typo. It means the stock is almost 7 times more volatile than the rest of the market. This isn't an individual brokerage holding, it's a casino chip. Let's look at the recent stock movement because it tells the whole story of this bull-bear war. The company's last earnings report in October was, on the surface, a huge win for the bulls. They reported Q1 2026 revenue of $64.2 million, which crushed the $48.6 million analysts were expecting. They also reported a smaller loss than feared, at negative 11 cents per share instead of negative 16 cents. This news was gasoline on the fire. It sent the stock soaring and triggered a massive short squeeze. You see, a huge portion of the market, over 32% of the float at one point, was shorting this stock. These were professional traders, likely on Interactive Brokers, who were looking only at the balance sheet, at the debt and the cash burn, and betting on a collapse. When the earnings report beat, they were forced to buy back their shares at a loss, sending the stock flying. That's the expectation winning. But today's 3.38% drop, that's the reality reasserting itself. The squeeze is over. The excitement from the earnings beat has faded, and now investors are looking at that $687 million in debt again and asking the hard question. This revenue is great, but can you survive long enough to see the profits? This is why understanding the business model is so critical. Applied Digital is not Apple stock or Tesla stock. They don't sell 1 million consumer products. They have 1, maybe 2 giant customers. Their entire $11 billion future is tied to the health of CoreWeave. This is the definition of customer concentration risk. If anything happens to CoreWeave, if they lose funding, if they see a slowdown, if they renegotiate, Applied Digital is in a world of hurt. The company is in a desperate race. They are spending hundreds of millions of dollars they don't have, which is why they have so much debt, to build these massive data centers. The bull case rests on the idea that once these facilities are built and the leases, which are set to start kicking in around December 2025, the cash flow will flip. The company will transform from a cash-burning builder into a cash-generating yield machine. This is the transition they are trying to make. But they are in the most dangerous part of that journey, the part where they can run out of cash before the revenue stream truly begins. This is not a stock for Schwab Intelligent Portfolios. This is not a holding you tuck into your Fidelity IRAs or a set-it-and-forget-it Fidelity mutual fund. This is, at this very moment, one of the most speculative, high-risk, high-reward plays on the entire market. The analysts are telling you to buy the story. The short sellers are telling you to short the balance sheet. The bulls see the 11 billion contract. The bears see the negative 772 million in free cash flow. This is a true binary bet on management's ability to execute, to walk the financial tightrope between here and profitability. This brings up the most important question for anyone looking at this company, for anyone doing their own self-investing and looking for investment help. Comment below with which side you're on. Is APLD a brilliant high-growth AI infrastructure play, or is it a high-debt construction company that's about to be crushed by its own balance sheet? So, as we watch Applied Digital hover at $31.97, know that this price isn't just a number. It's the exact knife-edge midpoint of the market's total and complete confusion. The expectation of an AI rocket ship fueled by brilliant press releases and massive contracts is colliding head-on with the cold, hard reality of a terrifyingly leveraged balance sheet. The story is a perfect 10. The financials are a 2. The battle between that dream and that reality is what's causing the 3.38% drop on your SoFi trading platform today. The market is trying to decide if this is the next Nvidia stock or the next high-profile bankruptcy. And right now, absolutely no one knows for sure. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. Baggage rocket! If you found this helpful, don't forget to like, comment, and share. Like, comment, reshare.